We're very fortunate to have both of you, and I'm very grateful you're joining us from Austin and from Maine. So also I should mention that Tim is a neighbor where I'm sitting on another floor upstairs, but today, unfortunately, he could not be here. He's in Maine. Britt, I was going to start with you. You recently said that climate change will cause a massive shift in capital allocation. 1.5 trillion has traditionally gone into the renewable sector, and about 6 trillion in the next 30 years will be invested. This will be the biggest capital flow that will occur in this decade. Can you talk a little bit more about what you see as the main implications of this huge capital flow?
Sure can. And it's not 6 billion, it's 65 trillion.
Okay.
So 65, this was 2 years ago. The estimate for the capital that would be required to move into this transition phase between now and 2030 was estimated at $65 trillion. So that's obviously 3 times the size of the United States. That makes it a pretty big capital reallocation. Today, that number is now $100 to $150 trillion. So we have never had a capital flow out of, primarily a single area, into another area with that size and that magnitude. So the implications of that are going to be number one, there's going to be lots of investment opportunity. If you're good at this, I'll give you our own history, because we've been doing this since 2008. We've made 35 investments in renewable related things. But the first 7 investments between 2008 and 2013 were pretty much all low return or outright losers. We were too early. This is the down payment that people make as you kind of come into a new sector, a new industry. Since that time, our average return has been about 12% across a wide variety of alternative, solar, wind, the whole shooting match. And we've had 5 investments that have had more than a 5x return. So I just want people to understand that history. But this capital flow that you're talking about, Afsaneh, is the largest capital flow ever in the history of humanity. And what people said, look, this is going to be stimulative. And as time went by, people realized it's not stimulative. It was stimulative because it had a minus 1% economic growth and a 2% stimulus associated with it. So the package was stimulative. This is, such an important issue that capital is going to flow into this area. It will slow down global growth, probably from 3% to 2%. If you look at academia, they have, at the outer skirts of academia, they've redefined optimal growth in the U.S., and around the world, from 3% to 2%, based on the fact that the industrialized world, in their view, has everything that they need, and that the per capita GDP definition was preventing capital from flowing into some longer term projects like climate change. So there is a contingency. So what is happening right now is there's no evidence that climate change has a risk premium, but there is evidence that you can create portfolios that have the same return that are more sustainable. And I think people are very enthusiastic about doing that.
Britt hit on this point exactly. Getting in too early, the returns profile looks pretty bleak. And as they say, if you're early, you're wrong. But in this case, I don't think that's the case here. You just haven't quite got up. The adoption or the winners haven't yet emerged. So I think we're sort of at that point now where the industry is more mature. You are seeing winners. But because there's still a substantial amount of technology risk, this is really one area where we've taken more of a diversification approach, trying to make sure that we're not making a single bet and getting it wrong on whether the adoption of a particular product, technology, or we back the wrong player in the space. So we've invested in a diversified fund that's on the leading edge of finding renewable power for electric vehicles by adopting battery technology. So we've also sort of tried to look at places which may not be as obvious, such as a more efficient grid, wastewater treatment companies, as well as companies that try to make buildings more efficient, more energy efficient. So we've tried to spread our bets pretty widely here, but at the same time recognize that not all of them will end up or will survive when it's all said and done.
I think, Tim, one of the things that you and I talked about earlier is sort of important to you at this moment is that while you're looking at some of these battery technologies, you're looking across the board on different diversified opportunities. Would it be correct to say that the transition that you see in terms of the climate friendly investments is longer than maybe some of us who are more optimistic, like myself and others who've been speaking today?
Sure. No, that's my belief, and I think history has shown that energy transitions, whether we're talking about wood to coal to carbon, and so forth, those transitions take quite a long time, usually over generations. And that's largely because the size of the installed base, the need to actually replace old technologies and old products that are supported by those technologies, it just takes quite a long time. The other reason, which I think is quite important and it should not be overlooked, like Václav Smil, who's a Czech-Canadian environmental professor up at the University of Manitoba, he noted that one of the most important uses for traditional carbon energy is in the developing world, where those countries and people who are still kind of supported by less technologically advanced means, they still have a huge need for carbon technology. And if you take away that or try to eliminate that, you're essentially condemning close to 4 billion people to poverty. The carbon right now provides one of the fastest tracks for developing countries into becoming more developed. And so because of that, I think that there's probably a longer lag on this than a lot of people like to predict.
And specifically on electric vehicles, something you've looked at, do you see that transition as 10 years, 20 years, longer? For some countries, I think in Europe, the idea is that really within a decade, there would not be new cars sold that are not electric or that are based on oil. In some other states in the U.S. also, there is conversations about similarly making sure that we jump faster ahead with electric vehicles. What do you think at this point, looking at the U.S. or outside the U.S.? By the way, the other thing I should mention to our audience, when Tim decides to do something, he goes the whole way. If he decides he's looking at Chinese investment opportunities, he goes ahead and learns Chinese on the side. He speaks a few other languages. But so looking at the US and outside the US, what do you think is the transition to the EV by your estimate?
Sure, sort of similar to my previous, we were just discussing previously. I think the more short timelines that have been floated about are overly optimistic. Largely, I think one of the reasons is because the replacements for a lot of the current vehicles on the road, current gas guzzling vehicles, is going to take longer than most people anticipate. Most current cars now, they're actually more reliable and last longer. So it'd be nice if we could all go out and buy EVs, but I think that's a fairly unrealistic option for a lot of people. Secondly, if you look at it mathematically, for all cars to be on the road to be electric by 2050, 100% of the cars sold by 2035 would have to be electric. And so that is just a really long timeline. And I think when you also account for the need to build out the infrastructure to support those vehicles and the transition to the new economy with jobs, I just think that we're looking at a much longer timeline than most people would like to admit.
Yeah.
What is your thought?
I'm back. Can I just jump in on that?
Absolutely.
Yeah. So it's to make this transition, it's going to be extremely important that the global citizens are prepared. And so right now, the global citizens are not prepared for how much it's going to cost. They're not prepared for how long it's going to take. And they're not prepared for perhaps a drop in reliability of energy before we get the benefits later on. So I think we have a huge educational issue, because the thing that will stop this eventually is, look, this is not what we were told in the beginning, and we're going to wax and wane through different kind of political administrations, but it's going to cost people. Right now the surveys show that everybody's for renewables, but then when you say how much are you willing to pay, 50% of them are saying nothing. And this, it's not going to happen as quickly as people want. We already, if you're listening to the IEA, it's kind of like this is definitely not going to happen by 2050. And if it's not going to happen by 2050, unless we come up with some other source of energy, we're going to have to rely on our current energy sources more than people think. But another thing that people don't know is our current energy sources, although they're still emitting too much, their emissions are declining, not rising.
But how do you marry that, Britt, in terms of the kind of investments that you said earlier we need for climate change? And if we look outside our windows, no matter maybe not where you're sitting, Tim, today, but at least in DC we have the haze from fires that are going on quite in a long way away in the West. Britt, you've had a lot of natural disasters in Texas and all the other countries and states. We can go sort of through long lists of things that are going on, and whether one believes in the extent of it or not, as you said, need for these investments. So when you look at your portfolios, if you take 3 decades to go through these changes, will there have been so much damage done to our environment that is, irretrievable, as it were? Britt, do you want to go first?
Yep. So I don't think we know the answer to that. Tim was talking about SMIL, and he's considered, at least in my circles, to be like the prophet of this issue. And his view is, look, this is mostly just that in these long cycles, you begin by underutilizing, in this case, the Earth's resources. You get in the middle and you utilize the Earth's resources in a proper amount, and then you overshoot, and so you have to have a period of degrowth. We're going to have to find a way, because the 2050 obviously was we're stopping emitting new emissions into the atmosphere, but we still have the ones that were out there to work off, and that would be till another 50 years. And a lot of these things are reliant on new technologies. It's just an assumption in these models. New technologies will emerge that we don't know anything about today, and that will fill in the gap. And so we're heavily dependent on because we can't get there from here with what we have now. I mean, we'll eventually get there. It's just going to be longer.
Tim, what are your thoughts?
Well, I think Britt's exactly right, and I also think it's important to highlight that investing in this field is actually much more nuanced than people people see it. It's not always just electric vehicles and solar panels and wind turbines. One example is there's a company down in Texas called Sterling Solutions, which does floor matting for the energy infrastructure space. And they created these floor mattings, which are 50% lighter, twice as durable, which means that the amount of timber needed to actually make them is less. So you get less deforestation, and you can actually reuse them because of the durability. And so again, that just sort of creates a much less environmentally destructive footprint than they have in the past. And so there are ways of going about it that are really that can be really interesting, but you have to go out there and try to find them.
Yeah. Right now, having a limited renewable footprint is a brand positive thing for your brand, really everywhere. So you mentioned that I teach, and so I said one time to these young people, I said, we don't have a solution to any of this kind of stuff, and yet we're launching on this huge experiment. And one of them said, well, you know what? If you spend $100 trillion on something, I bet you can come up with an answer. And I think that's what we're relying on.
But the same young people, I think, Britt, that you're teaching, their tastes are changing, right? A lot of the millennials who work for you and that, work with Tim and in all the companies you're invested in, their tastes are changing, right? And
yes.
Needs are changing. We looked at just the ETFs and just especially if you look at younger people again, 95% of them worldwide say that they want to invest in more sustainable companies. So given that, how does that change the kind of, investments and allocations that you and Tim are making?
It's a simple demographic thing, right? There are more of them than there are of us. And this is their number. It's not complicated. This is their number one priority right now. If you survey them, issues with regard to climate change is their number one priority. And there are 52 million voters in the United States that are in the millennial category. And there's 40 million boomers. And I'm not saying that both categories are 100% either way, but if they were, they're coming, when we came in, we got to express our top priorities. And now they're coming in and they get to express their top priorities. I make a prediction right now that within the next 5, certainly 10 years, when you analyze a project, it's going to have one, the risk return stuff that we all do right now, let's say it's a 10%, and it's going to have a second environmental or ESG rating. Let's say it's 1%, one on a scale of 1 to 10. And you're looking at 2 projects, and one is 10% with a 1 environmental rating, and one is 7% with an 8 environmental rating. And people go for the 7.
Right. One other question I have, both obviously in Texas and Tim, you and I've talked about this before, which is the share of energy in just MSCI or whatever index we want to talk about has gone down, right, from 17-18% to 2-3-4%, depending on what index you're looking at. So when we look at that, do we see energy companies, equities that, of the energy companies as having been, particularly in the last few years, as less desirable? On the one hand, of course, this year with all
all about price, right?
Yeah, exactly. We've had the opposite going on this year. But looking again at the last few years, how do you both look at oil markets?
Tim, why don't you go first on that one?
Sure. So I think that investing in traditional oil companies is, again, not always black and white. I think endowments and other institutional investors that have a significant amount of pressure on them to divest from energy companies are certainly very well intentioned, but it's also very difficult, I think, to look through the haze and some of the talking points to see that not all energy companies are necessarily bad, but certainly significant improvements need to be made. And I think that the pressure that has been forced on some of these energy companies has been very positive. And so you're seeing much more of a socially socially aware approach to the way that they've performed business, and that's actually been very productive in how they've been much more diligent with their capital. They've started to clean up some of the more environmentally less clean practices. So there's been a tremendous amount of progress there. That's not to say that it's all the work is done. It still has a ways to go. But I still see the energy markets, traditional energy markets, as playing an important role in the traditional economy. Certainly there are a number of jobs that are supported by energy markets, and those are going to take a while to transition while skill sets evolve over many, many years.
So just to add so right now we have this emissions issue, and so we're going out to all of the big public companies, and the first thing I want to mention is the massively so just think about Exxon, a little bitty company, maybe $250 million of assets under management, comes into Exxon and somehow ends up getting 4 board seats. I mean, that's just, normally you just swat somebody like that away and do what you want. Why were they effective? There's a massive concentration of proxy voting in passive funds. Passive funds are more than 50% of the capitalization of the U.S. So BlackRock, State Street, and Vanguard are essentially the biggest shareholders in every company, in the United States, that's public. And then you have CalPERS, CalSTRS, a place like New York. So this little tiny investor is just the front for a massive amount of capital that's behind them that is wanting to make these changes, for one, because they think it's good, but also it's because what their customers want. And so that I just think that needs to be recognized. Now, when you look at traditional energy, I mean, I'm probably the only one here who's old enough to know that there was a time that we were actually dependent on foreigners for our energy, which is a horrible place to be. It's like being slaves to others for pretty much everything you do. And the energy industry has to be recognized for a miraculous advance in technology that got us where we're not dependent on others for energy. And that's, that is just an amazing factor. If you want to know where the real productivity increases were, that's where they were, because the price of energy was staying the same over time. Now, between 2010 and 2020, all this collective effort yielded no returns whatsoever in the aggregate for investors, because the business model of the energy sector was based on increases in production, not cash flow or increases in profitability. So what's happening now is you're going to see these companies, they're going to shift away from increases in production to increases in profitability. They won't get funded, and they're already doing that. They're already doing that right now. So, and the third thing I just want to mention here is the new word after the pandemic is resilience, right? Is resilience. So I'll just give you a little Texas inside baseball. When all this happened, there was a meeting at the White House, and all the majors and all the people who are important in the energy sector were there one day. Our chairman's name is Jeff Hildebrand. He is the largest independent operator of oil in the world, and he represents usually all the independents. So I came back and I said, Jeff, what happened? He said, well, not a lot. So everybody, the big guys, were asking, what do you think? And they all said, look, we can make it through this, although it's difficult. And then when he got there to represent the little people, the little guys, he said, I don't know what you're talking about. If we don't get some kind of support, this whole thing is going to fall over. And so the message there is the government, the previous administration, I think this administration as well, they do, if everything consolidates into the big energy companies, they're fine with it. They're absolutely fine with it. Matter of fact, I think they think that's what they would prefer because it increases resilience. Now, whether these big energy companies can not only change their business model, but take the scale and the skill that they have and turn it toward increasing renewables, they have the advantage, at least in terms of capital, if they can get any, and size. But we're going to need them to come through. And I just go back to when you talk about emissions. If you go back to 1990, Europe goes first. They peak out in 1980, and they've been coming down since 1980. America goes second. We peak out in the 1990s. We've been coming down. We need to come down more. But in 1980, Japan comes on the board, and Japan is now producing more emissions than all the rest of the world combined. So one of the things we have to do to beat this thing is, recognize where the really the important pulse points are, and just finally just say, and China negotiated for themselves 10 extra years before they have to sort of even get serious about doing anything about climate change. And the reason for that, of course, is their living standards are too low, and they want to rely on hydrocarbons because that's the fastest way to progress right now.
I think that's a really good point, Britt, in the sense that the source of pollution that might have been at one point the US has shifted now, right, to other countries. And Tim, you obviously look a lot in the US markets, obviously, but also outside the US. And while we're going through other issues right now with China, a lot of political and other economic issues that are going on, when you put that aside for a second, on the one hand, from an emitter point, China obviously is and will continue to be one of the largest emitter, but also on the side of investment opportunities, one of the areas with the highest number of potential investment opportunities. How do you look at that today?
Yeah, so emerging markets present an interesting opportunity, and China in particular. I will say that some of the challenges of investing in this space in China are different than maybe in other countries, where in the other countries you may sort of focus on the technology and whether that is going to end up advancing to a point that it's going to be sustainable and widely adopted. That is still the case in China, obviously. However, we would also look at things like corporate governance and the regulatory environment, which we would sort of overweight there. That being said, when opportunities do present themselves, we get pretty excited. I think one obvious example is BYD, which is a leading hybrid and electric car company over there, and that's had a tremendous run since it launched its first plug-in hybrid in 2008. There's other companies over there that do some fairly creative things that try to improve the lives of the people, especially those that live in highly polluted cities, such as Xiaomi, which manufactures sort of personalized at-home air filter units. And that's been I know a lot of people over there who use those units, and they say that their lives have been immeasurably improved just because it'll clean the air that's circulating through their apartments. So there are interesting opportunities over there, but it's as you know, Afsaneh, better than most, it is an extremely challenging place to invest, and so you've got to be really cautious.
Britt, are you doing a lot in emerging markets, and do you look at climate as a subject that matters when you go there?
I mean, everybody's looking at climate as a subject that matters now. So we have $3 billion in China, about half public, half private. We've been investing there since 2010 or so. We've had a lot of success. The private is 20%, the public's 17%. I mean, as an alpha opportunity, it's just, particularly on the public side, I mean, just huge gaping holes, to pass through in terms of alpha. And so we have a lot of money there, and we've had a lot of success there. Now, I have to tell you that today I just had a meeting with some of our investors, and I said, I want you to go out and I want to have a contingency plan for, things that have a higher probability of happening than we used to think, which is either that, that they close down their borders with regard to capital, or our government says that we have to, divest of all their capital. I don't think this is the most likely scenario, but I think you're foolish not to think about that. The because these two countries, we have never had it. The United States, it's like the young king is still here, and the one who is resurrected from the dead, is back. And the two are going to vie for global supremacy for the next 20 or 30 years. And the world is watching. I think they prefer the United States to win, but it's not an obvious thing. So everybody's just kind of standing back, saying, let's see how this is going to work out. So you have to be very careful. I would really make sure that if I was investing in China, that my unit was Chinese, the citizens as much as possible, and that I had a location in China, because if they cut the cord, it's going to be all China all the time.
Interesting. I think that's on a lot of minds. And as you said, both whether you're looking at it from a climate perspective or geopolitical perspective, or, the two coming together, it's going to be an interesting story to watch. And
the Olympics are going to be very interesting as well.
Exactly. Britt, one other question I had for you. You had probably the most successful Bitcoin conference in recent history, and you had thousands of people come, including some in person. That, obviously these currencies also have a huge climate-related implication. And was that something that came up a lot? Did you discuss that much at the conference?
We didn't discuss it a lot, but it is a key issue and it is on people's minds. And, we had thousands of people come to this conference because Bitcoin first of all, it marked a high for Bitcoin. But Bitcoin is out there as an alternative currency. And what the Bitcoiners miners would say is you have to measure the impact on the one side against the benefit on the other side. And, and they would say, look, if the tech sector, if it would just get its act together, would be multiple fold more important than everything that Bitcoin is doing. If you're talking about China's the carbon tech in China is like $8. In China, it's going to have to be 150. The ratio of coal to gas is 20 to 1. Ours is, I think, 0.2 to 1. So everybody should look at everything they're doing because we want to be as efficient as possible. But Bitcoin is not the big fish.
True. Not yet, anyways. Not for. My last question really to both of you is, what other messages do you have for our audience? Is there a way to be maximizing return, which is, your objectives in terms of whether it's Keystone or UTIMCO, but at the same time having climate-friendly solutions, starting with you, Tim?
Sure. I think there are a number of opportunities out there, but you do have to be creative, particularly as capital continues to flow into a number of opportunities, which has obviously increased valuations to a point which can be very difficult to accept, particularly if you look through it with a more value investor lens. I would also like to highlight one thing that shouldn't be lost is, and Britt just hit on this, there's a benefit to a lot of this. There's also a cost to it. Right now the production of electric vehicles, in some studies have shown that producing an electric vehicle is something like it emits about 70% higher amounts of greenhouse gases than does the manufacturing of a traditional car. We also have 85% of the world's rare earths are found in China, which I think a lot of people it's been heavily criticized for the way that they've sort of gone about their mining practices. And they've got 2/3 of the world's cobalt, which is found in the Democratic Republic of Congo, which is not exactly a beacon of human rights. So there are costs and benefits across the board, and I think that we really should be careful and look through the sort of the superficial lens of a lot of investment opportunities and try to understand what's really behind them and see if we can actually continue to do things better and get to a more sustainable future.
Thank you, Tim. Britt?
That's very good.
Very thoughtful.
Yeah, so I would just say just a few things. Number one is everybody should recognize, at least in my view, like we're at the end of a 40-year era and we're entering a new era. And that last era, the only thing I'll focus on here in that last era was about hydrocarbons. The era that we're going to have now, and I don't know how long it's going to last, is going to be about moving away from hydrocarbons to more renewable, more sustainable things. We're just nobody's debating the fact that that's going to happen. We're just debating how it's going to happen or how long it's going to take. So it is the number one. I believe it's the number one goal of the world right now. If we just had one society, like what's the number one goal of society? I think climate change would be the number one, and this is going to persist for at least 30 years. So this is not something that's going to come into fashion and go out of fashion, but it's also going to have a lot of ups and downs and huge successes and major failures. And we just have to keep progressing through. So everybody, at least for me, I just told our guys, forget about what you might think about it one way or another. This is going to happen. So prepare yourself to both benefit from what you can find that will be beneficial, and to avoid the things that won't. This could be another internet type of situation with a lot of things going on, and you may eventually come out with some dominant companies. I wouldn't be surprised if in 2040, Amazon was not dominant anymore, and there was somebody we never heard of that would come out of this particular sector. But it's no one should go in here thinking that this is easy pickings. It's going to be tough, and most people now are kind of like, I want to express my sustainability. Don't get yourself in the mode that I'm going to get a huge risk premium for this. Right where we are right now is I can get the same return and within a more sustainable way, and that's where we are now. And we'll see where we go from there.
I can't thank you enough for your very thoughtful comments and ideas, and look forward to our next conversation. Thank you, Tim.
Thank you so much for having us.
Thank you,
Tim. Great being with you.
Likewise, Britt. Thank you.